The really interesting metric that we've honed in on recently is, and I think it's really important for founders to know this, what is your actual revenue versus your contracted revenue? Very often, founders will report on contracted revenue. We've signed this agreement, it's great. However, it's a staged deal where eventually it'll ramp up to $1 million in this contract, this example. However, the actual revenue is $50,000 for phase one. Those are drastically different things that we have to take into account. So because of that, because of our system, we'll get insights and be able to double click on, okay, so you are reporting that this is doing $1 million.
Hey everyone, welcome back to the Ignite podcast. Today we're delighted to have Collin Groves on the program. He traded small town Oklahoma roots for a Georgetown MBA, launched 5 corporate VC arms while at Ernst Young Parthenon, and now steers a single LP fund backed by Latin American dev giant BairesDev. His remit wire founders both cash and customers through the same outbound engine that scaled BairesDev's 4,000 engineer rocket. He's led investments in 50 plus B2B SaaS deals across the Americas and loves de-risking growth with hard data. Think of him as a venture capitalist who shows up with a box of warm leads instead of swag. That's awesome. Thanks for coming on.
It's a pleasure. Thanks for having me.
So yeah, maybe give us your origin story. I mean, I kind of breezed through it there, but I'd love to hear like kind of the roots of Collin.
Absolutely. So you mentioned Oklahoma, and I can start there. I grew up, and this is a similar story to a lot of VCs that the more that I meet is we didn't really know what venture capital was or startups were. I grew up where the cities ran with oil, and that was the backbone. Then it was backed by real estate booms like that. If you look up the history of Oklahoma, though, and Sam Anderson's book is fantastic about this, but Oklahoma as a state was built on the boom and bust of not just oil, but as a city. They were one of the first, they were one of the last states, but one of the first to test out what sonic booms did to the entire population. And that was just because the state needed more funding. And all of a sudden you saw a boom in the economy after that. So I grew up in a cycle where there was a lot of boom and bust, but there was no label for it in terms of early stage companies. And I kicked off my career then obviously going into energy. I was at Phillips 66 at the time. And then I went and got my MBA, and then I went into consulting. And in consulting, I had an idea that I wanted to be in venture, but I wasn't entirely sure how to navigate that. And so I did about $5 billion of M&A work, and then worked on some digital transformations. And the digital transformations were very eye-opening. And we would plot these use cases on pain points across B2B, B2C, or supply chains. And usually what we would do is to plot those use cases, you would find a company, a partnership, a startup that could fulfill them because they can build it and adapt to the market a lot quicker than these billion-dollar corporations could at the time. But there was a lot of red tape. And so what we came up with was this framework of build, buy, partner. And then we came up with a fourth element of that, which was invest. And so what we found is corporations do the first 3 really well. They're great at building. They're great at buying. They're fairly good at partnering. They don't always have a great connotation when it comes to investing. And I think when we hear CVCs, even as VCs today, it's not always the best. But there are some incredible examples out there of corporates. And so a partner and I were the founding members of this corporate venture capital as a service offering where we would go to corporations and help them set up their venture investing arms. Sometimes that would be traditional standalone VC funds. Sometimes that would be off the balance sheet investing. Other times that would be through a CFO's discretionary funds. But the entire premise was unlocking innovation at the corporate level, getting access to incredible talent, and oftentimes we were augmenting their entire M&A strategy. And so we would come in and we would set up these funds and help them get established and start making their investments. And that ultimately brought me into the venture landscape where I was brought over to BairesDev and BDev Ventures now to set up and professionalize the investing. And so when I was here, I think when I first came 3 years ago, we'd done maybe 4 investments, and now we're up to 60. So we've ramped up really quickly, and we're really active in the B2B SaaS market.
I just realized I said BairesDev the wrong way. I'm sure that happens a lot.
It happens quite a bit. I'm sure that there are days when I pronounce it incorrectly.
Yeah. So what is BairesDev for folks who don't know?
Yeah, BairesDev is the largest bootstrapped IT offshore development company. They hire Latin American talent and then partner with US companies to develop or augment a lot of their software development. And so they've scaled to a couple hundred million in revenue each year, a fully bootstrapped company. The founders of BairesDev are the single LP that backs BDev Ventures. And so as BDev Ventures, we leverage some of the tools that BairesDev has helped organically create to scale up their operations. And so we've got a few tools that we test out before we invest. As a form of diligence, we consider it sort of the best in class diligence because we will bring companies leads before we invest. We want to show our value so that founders are actually fighting for us to be on the cap table instead of just competing with cash like a lot of traditional VCs do. It gives us, we think, a little bit of an edge there from a financial standpoint. If we can drive a lot of leads to the company, I can underwrite a lower beta and higher alpha on these companies and exits as well. And so that's where it really becomes attractive for us as a fund. And where we lean in is where we can add a lot of value to. We'll start to invest capital. And then over time, we invest a lot more because as we drive more value, we bring in and receive even more conviction.
That's a really interesting model. Yeah, bring customers, have them kick the tires, use it a little bit, give you feedback. What's in it for BairesDev to have a venture capital arm? Like, what was the kind of the...
Yeah, well, to be honest, they work in software. Startups are even growing in that space. They were starting to receive a lot of interesting companies headed their way. And the idea was, we could potentially partner with them as customers, or we could get equity in some of these companies and start to grow that way and diversify, but also have a greater influence over what we think are tools that work really well. And if we can help them scale, the return should be great as well.
Yeah, it's an interesting network play here, right? And I remember when I was at Microsoft, they went through this transformation where for a while they only did balance sheet investing. They didn't really care about the strategic fit. And they're investing in all kinds of stuff like electric helicopters and stuff like that, which had no really strategic fit to Microsoft. And then they hired a new managing director. You probably know about this. And they kind of reoriented everything to, what does Microsoft care about? Security and, et cetera, et cetera. And so they kind of reoriented the venture capital arm to be more strategic. So it sounds like at BDev, you guys are much more of the latter, much more of a, hey, how does this fit with what we do at BairesDev? How does it help us, help our companies, help our customers, help our developers? And how does this fit into the whole ecosystem of what we're trying to accomplish as a company?
That's right. If you think about the three investing vehicles, there are corporate venture capital funds, there are family offices, and there are traditional VC funds. I like to say we sit right in the middle of them because we have elements of all three. From the corporate standpoint, we have value add tools where we can help you scale. And we'll drive anywhere from 3 to 45% of our portfolio companies' revenues. That is a lot more like a corporate venture capital fund. Family office, though, we have a single LP. At the end of the day, we report to one person who makes decisions for us, and we can scale up or scale down appropriately. And then on the VC side, we hold ourselves accountable to traditional VC standard terms, methodologies, and metrics. Now, we move really quick once we have conviction, but we also want to take our time and understand that if we can be somebody on the cap table that can actually help this company grow, we're willing to wait a month or two so that we can prove that value, because it also, for us, is giving us a lot of data and insights into the company as well, extra touch points, which I think in today's world are sort of undervalued, is we get to work with these companies hand in hand and helping them grow. We learn about the founders, their go-to-market strategy, a lot deeper and than most VCs do.
That's really interesting. Let's talk about the mechanics of the fund, because it's a single LP. Are you guys actually forming an LP kind of GP entity, or is it just sort of like off balance sheet and there's some entity that invests?
That's right. So we do have a traditional GP LP set up, but it's more of an evergreen fund structure, but all the same metrics that would go into a regular fund. We have 2 funds now that we've set up, and we leverage both of those going forward.
Why 2 funds?
Our first fund was sort of more of the strategic element, where if we could drive significant value, then we would invest a little bit. Now with our second fund, we'll invest more money, more capital, and we're willing to double down out of that second fund as well. So it's more of this opportunity fund that's also all of our new investments. We consider it our main fund.
Got it. Got it. And then are you incentivized as a GP of this fund on carry? So there's actually, you have skin in the game, so to speak.
Yes, we do. And
interesting.
I think that's actually a great question when you talk about the history of CVCs as well, which was a world that I came from. There's an allegory that has gone around, and to the validity of it, I don't know, but I can tell you it resonates. And it was at a healthcare CVC, call it 10 years ago, where one of the associates made a larger bonus than the CEO of the company did. And as you can imagine, that ruffled some feathers. And so all of a sudden, these corporate venture capital funds stopped giving out carry, and they pivoted to phantom stock or phantom carry, larger bonus, second bonus pool structures, or just act like a traditional employee. Well, as with most things in our industry, they're cyclical. And all of a sudden, we're starting to see those CVC funds today operate more like VC funds and restructure themselves, some spinning out into their own venture capital funds, like Hitachi is their own 2 and 20 VC model. But we're starting to see that because the importance of talent. And talent, of course, is important with startups, but it's also important with your VCs and your investors. You want really talented investors that can do, I think now, 3 things in venture. The baseline is you have to be able to source great companies. The second is you have to be able to add value to those companies. And then the third is you have to optimize exits, especially in a world in which private companies are staying private longer. Those ultimately, it's making venture harder, to be quite frank. And so you want to retain the talent that can do all 3 of those levels or operate on all 3 of those levels. And so you're starting to see CVCs who have bled talent at times flip to a model where they can incentivize in people to stay. And they can then incentivize and bring that down to the startups that they invest in, because they can say, we have people that are here for the long run that are going to help you.
You know, it's funny you mentioned timing liquidity. It's something I'm struggling with right now because, you know, as we discussed, I was just talking to this multifamily office right before we started recording. He's like, oh yeah, great. So your 2022 vintage fund 1, we're on fund 3 now, and we're about to raise fund 4 at some point. Not an offer for securities, disclaimer. So hey, on your fund 1, do you have any DPI? I'm like, well, no, I don't. But, you know, we have a massive amount of markups and we could generate DPI if we wanted. How important is that to you? And, you know, here is the trade-off, right? Okay. I generate some DPI, like I have a 20x return. So a 20x return on one of my investments will probably, you know, return. Oh, this is on fund 2, actually. This will return 10 or 15% of the fund because we do a high volume of investments, you know, 100, 150. So I could sell off that position or sell most of it and generate some DPI. But what if that company that's worth $100 million goes to $1 billion or 10 billion? And I missed out, right? So I turned a 20. I got a 20xer, but I missed out on a 200xer or 2000 of multiple. That's really painful. That's actually, for me as a GP, way more painful than not being able to raise money because I don't have DPI. So yeah, I don't know how you guys think about that as a single LP. How do you time liquidity? When do you know to exit or trim positions and stuff like that?
It's a really challenging problem, but a very interesting problem from a mathematical standpoint. And so when I kicked my career off, it was as a commodities trader. And so we were constantly flipping in and out of positions and having to optimize on what we had and didn't have. And venture is a little bit like that as well, especially when it comes to the exits, because could you redeploy that capital if you were recycling fees, let's say, into something that could generate another 4x with that capital versus...
No, I don't have recycling, so that's one thing.
You don't have recycling, which makes that decision a little bit easier. But
right.
I think about it in the sense of, you know, when you do your model portfolio, a 20x will most likely get you between a 2 and 3x TVPI. A 40x, all of a sudden, you're in top quartile, top decile. And so to me, that ultimately becomes a lot of the decision maker, which is when you look back at this fund, what's going to help you fundraise next time? Is it that you're top 50% or that you're top 10%? And so that's from a macro scale. From a micro scale, we evaluate every investment and every follow-on as its own individual investment. I'll pull up a portfolio company today. It's Pinata, it's a competitor to the Built credit card, but they access the entire credit of individuals rather than just 720 credit scores or above. So the TAM is significantly larger. They have got incredible partnerships and they're doing some incredible things on the fundraising side. And so our first investment was underwriting they had 600,000 renters using the platform, but revenue was, I think, under $1 million at that time. Today, or north of 10 million in revenue. It's a completely different business. And so to reinvest, we create a brand new due diligence. We go through diligence all the same way as before. And luckily for us and partnering with incredible founders and incredible companies, we've reinvested again in Pinata, and we'll probably continue to. But each time we do that, we're going to evaluate it, because the cap tables change, the terms change, everything changes when you get into those later rounds. And so it's tough to say from a micro scale, hold on, but from a macro scale, it almost always seems like the right answer.
What's the right answer?
Hold on until you know you can turn the fund and get to a top decile, top quartile.
Right. Yeah, or trim when things get ahead of their skis, maybe trim a little bit. Oh, they just raised a 200x forward revenue and there's some hot AI company, I would maybe say so, trim.
All of a sudden you see Palantir in the public markets trading at 200x PE right now. And so there are ways for partners to back into saying yes. And you can justify it afterwards. It's harder to justify it in the moment.
Yeah, it's a challenge. Yeah, a little DPI would help me fundraise, but more TVPI and DPI in the long run helps me in the long run. So this is something that GPs struggle with.
Problem to have.
Good problem to have, right? Yeah. Yeah. Well, yeah. And you just have to convince your LPs like, hey, that TVPI sitting there is real. It's real markup. And I'm not going to sell my real markup just so you have DPI right now.
And as long as there is a path to exit too, I think right now in the world of AI, what we're seeing is a lot of really interesting projects with unclear outcomes. And that ultimately becomes a challenge when we're looking at and evaluating some of the newer deals that we're seeing in newer startups. Is you're interesting. How are you going to generate DPI? Because we have a fiduciary duty to our LP. Other investors do too. Angels don't have that necessarily. And so they may underwrite things differently. But are you able to actually create not just a product, not just a business, but are you able to create a company out of this that can be purchased? I think a lot of what we're seeing right now in the market, especially at the earlier stage exits, is you're seeing a lot of aqua hires or buying somebody's book for a discount. And so I think that there is DPI that can be created on that. And it's really easy to underwrite TVPI on that. But are you going to actually return the fund on some of those ideas? Maybe.
And for anybody listening that doesn't know what we're talking about, TVPI is total value to paid in capital. That's kind of like all your markups versus like how much has been paid into the fund.
I think of it as paper money versus real money.
Yeah, and DPI is real money. Like you've actually distributed money back, and it's the ratio between money paid in and money paid out. So you probably have, you spun up some corporate VC funds. What scar tissue or superpowers did that give you?
It's a great question. Reflecting on that, there's really three things that come to mind. The first is, if you're going to add value to startups, you need a tangible, repeatable path to do so. Corporates struggle with this because there's so much of the corporate that you can work with. And let's say you want to work with a healthcare company. Well, are you going to team up with the scientists? Are you going to team up with the supply chain? Are you going to team up with the product development team? Are you going to team up with the finances? So we always talk about having a liaison. There needs to be a liaison that can help startups extract value. And you'll see this at large firms like A16Z. They have 150 people on the portfolio side that are helping scale companies, but it's smaller VC funds like ours.
They have 100 partners as well that make the investment team.
That all have incredible experience.
It's massive.
But how do you tap into that? It's so difficult for a startup to say, we've got 50, you tell them we have 50 ways to add value. Well, you need to have a position or somebody that can help them navigate that. And so the liaison role is really critical. The second thing from the corporate days we figured out was your time to diligence is critical. In the energy space, a lot of the corporates, they take a very long time to do diligence, call it 18 months on average. It opens eyes a lot of the time when I say that, but it's true.
Sometimes I diligence for 18 minutes.
Exactly. And so your time to diligence, you have to understand very clearly and be able to articulate it to a startup how long you expect to do diligence. And then you have to know what the value of that diligence is for you. Don't just do diligence to do diligence. There has to be an endpoint. There has to be.
This is a really important distinction for, I think, GPs, especially listening out there, if there are any actually listening to us blabber on about venture capital. You have to learn when to really dive into diligence and when you have to move really quickly. That's something I've learned after doing 230 plus investments now over 5 or 6 years of other people's money. That is because I did angel investing before that. Sometimes you got to move really, really quickly to not lose the deal, and you have to kind of have a hunch for that. How full is the round? Who's leading? Like how far along are you?
And when you're a
No.
lead versus a co-investor, it's two different strategies too.
Right. Yeah. We're writing small checks later in the round. So
You maybe
we kind of know where we sit.
without a lead, right?
Oh, yeah. I've gone first check in with MFN all the time. Go in without MFN because I want to protect the downside.
And that makes sense.
It also depends on the runway and kind of why they're raising, right? You know, the best companies, like they've raised 500K. We've gotten to 3 million of ARR. And now they're kind of like, yeah, we're going to raise to go after the market. I'm like, wow, this is great. You know, the capital efficiency, you got product market fit, you're growing 30% a month, you know, without burning money. Those are the no-brainers. Move quickly, get the MFN side letter, be first check in. They have a business, right? The hard ones are like, okay, we burned 3 million, we have 500K. It's like the inverse. We have 500K of revenue, but we think we're there now. We think we have we're starting to see some market pull. Okay, great. Now that's a slow due diligence process to me. I'm going to dive in a little bit more.
When you look at startups now that are coming in and they're scaling revenue really quickly, how are you thinking about churn? Because traditional methodology would say that as you scale revenue, there could be less defensibility, moats, et cetera. So you're more likely to have churn, which can, quite frankly, destroy a business.
Yeah.
At least destroy their...
Yeah, leaky buckets are bad. Yeah, leaky boats are bad and leaky buckets are bad. I think you have to look at logo and revenue. You know, for B2B software, if you're anywhere north of 90% for the year, you're in, top 10% territory. And then anything over 100 net revenue retention is really great. So, if you see like 130% net revenue retention, that's amazing. And anything single digit logo churn is amazing. I don't know. How do you guys kind of evaluate that?
It's tough to use NRR and GRR. We like to, but it's kind of like using CAC and LTV at a really early stage. At Series A, it'll influence something more, but at seed stage companies, it's difficult. I mean, what we anchor on pretty heavily are 4 areas. The first is, can we add value to a startup? Obviously, given our methodology and investing thesis. The second is the market. And we can get a good grasp of the market, size of it, what it's growing, white space, et cetera, competition. The third are the metrics, so the financial metrics of the company, which we usually look at kind of high level financials, growth rate, burn, cash on hand. We'll dig deeper into a financial model, but if a company sends me projections, it's usually getting put deeper into the Google Drive.
I don't even look at projections.
Yeah. And then the fourth area that we look at and we anchor on more heavily now than we used to is the team. And Ben Horowitz actually talked about this back in the day, but not just the founders, I'm talking about the team. Having a great founder that has multiple exits is fantastic and it's an easy decision. And they likely will attract a higher multiple, or call it just valuation, depending on what revenue is or the business model. But we look at team. So not just that founder, but are they able to build a team that can help the founder get leverage? And by leverage, I mean, can they take out a task and do it better than the CEO can do? That way the CEO can focus on their superpowers. So if you're going to hire a CFO, you want to hire somebody that is building financial models, building out the FP&A, probably handling HR, usually handing out projections, the data room for fundraising. Take all of that away and do it better than the CEO could. If they're not doing it as well as the CEO could, the CEO is going to look over them and they're not going to be able to leverage their time and skills. And so we look at the team. Are you bringing leverage?
Yeah, I love that. Speaking of that, I'd love to kind of revisit the 90-day pilot thing. Tell us more about that, how that works, and kind of what milestones you're looking for.
Yeah. So background on this is we'll source companies and the traditional methodologies and ways, and we'll bring them in to test out one of our tools. And so we let them test out our platform called Win Different. It's a cold outbound platform, and we'll let them test that out until up to 90 days or until we get a lot of either the fund around is being raised or we get early signals that we want to move quick. The reason we do this is, and I mentioned this before, but we want to show that we can add value. We think of it as a great form of diligence, but we also get insights. And so we get clear indicators on what the open rate is, what the human response rate is. Are the companies able to actually sell on the leads that we send them? What's their true sales cycle? They may tell you it's 30 days, but is it much closer to 120 days? Because that also changes how we think about businesses. And then it gives us a little bit more insight into more qualitative factors as well, meaning, do they know their ICP well? Not just the people, but do they know the copy? in the messaging that's going to land with their customers? Are they able to build a landing page that actually gets people interested in clicking through, that isn't just driven through word of mouth, but they can build something that either is visually appealing or from the language on the page attacks a problem that a customer has? And then the last thing is we just get a lot of touch points with the team. So we learn a little bit more about them, how they work. And because venture is a long-term partnership, some call it a marriage, it helps us understand, is this a team that we want to work with for a long time?
What kind of metrics lead to like, oh yeah, we got to lean in and probably invest in this company?
So,
and what kind of metrics like, it's not working?
Well,
I just don't think they have product market fit.
At a high level, you've got revenue. So if revenue is going up, doubling in those 90 days, it's a clear indicator we want to move on really quickly.
Yeah, if you're able to double revenue in a quarter, it's like, okay, yeah, let's definitely dig in here.
And we've seen some of those happen, but they stall out afterwards. And what we can tell is they just had a massive pipeline before, and that pipeline has stalled out. So revenue, pipeline, because we always look at, and we plug in directly into their CRM. So we send them the actual leads and get it scheduled for them. And so then we get insights a little bit more into the pipeline. So revenue, pipeline. We look at a lot of the conversion rates as well, and we group them into quartiles. So are you a top quartile in terms of conversion rate? And we'll also factor that out horizontally by the different industries that you're in. So within prop tech, are you more responsive than the historicals? Within manufacturing, more responsive? Or you may get less leads comparative to your audience size, but are you closing those leads a lot more efficiently as well? There are instances where we've sent a company hundreds of leads and they've closed 0. There's instances when we've sent 30 leads and they've closed 18 of them. Just because there's a lot of metrics doesn't necessarily mean it's the best company or best decision to make. And so it also depends. Unfortunately, I wish I had a golden number. I wish there was a rule of 40 for leveraging this, but there's not. There's a lot of other factors that get built into it, which is why we still conduct diligence afterwards. But once we conduct diligence, once we run a pilot, we write a term sheet and we go pretty quickly. So our diligence afterwards could be 2 weeks.
Are you guys leading rounds, or what's your check size? Are you taking board seats, all that stuff?
We're co-investors. So smaller checks like yourself. First check is anywhere between 100 and 500,000. Second check is up to 3 million. And the reason we do that is we like to think of it as a flywheel. So we invest, we show our value at first, invest a little, ramp up our value add, because we can't give everything to pilots, right? We have to keep some stuff for the portfolio companies. And then as the company grows and scales, then we'll invest even more. Now, that doesn't mean we will just automatically put a lot of money into companies. We really do look for capitally efficient businesses. And so some of our best investments are companies where we own 10% because we've gradually invested more, but they're capital efficient, not very dilutive on the cap table. And now their revenues are north of 10 million and they've probably raised $3 million. And we're a good portion of that. So all that to say, it's important for us to just know that we can fit in really well and we know what the future of the company is. And because if a company is going to raise $25 million, they aren't going to need our value add. They'll hire teams and they'll outsource it and they'll outgrow us, which is also why we focus on really seed to Series B, with most of our investments being seed to Series A. That's when there's a sweet spot of product market fit, traction. Now let's put pedal to the metal and we help drive that.
Yeah, I love that. So after 50 deals, which red flags still trigger like an instant pass? And I'll take the opposite of that too. Like, which are some non-obvious green flags that convince you to preempt rounds?
It's a lot of the same ones that you would initially think of, but exacerbated. So we will hear stories about founders and partners or board members where they've fallen out of luck in fallen out of favor in the 3 months we've worked together. It's really hard to find conviction in teams that can't even stay together for 3 months.
One of the co-founders leaves. Yeah, that's...
Founder leaves. We'll talk to other investors and they'll say that something happened in the last couple of months that they're not going to come back in and invest. That's a good signal for us. And with our model, what we found is a lot of our co-investors, they want to bring us more of their portfolio companies so that they can test it out, see if we can drive some leads. Because at the end of the day, if that doesn't work out, then you've at least walked away with a few leads if we don't invest. And so we meet with other VCs quite a bit and other investors and angels. But yeah, the team, how that's working out, or with your other investor sets, The other thing that we will see as well is how revenue is stalled out over time. Because we look and talk to them for 3 months, we'll start to see what does revenue actually fluctuate or grow or decrease over time. The really interesting metric that we've honed in on recently is, and I think it's really important for founders to know this, what is your actual revenue versus your contracted revenue? Very often, founders will report on contracted revenue. We've signed this agreement, it's great. However, it's a staged deal where eventually it'll ramp up to $1 million in this contract, this example. However, the actual revenue is $50,000 for phase one. Those are drastically different things that we have to take into account. And so because of that, because of our system, we'll get insights and be able to double click on, okay, so you are reporting that this is doing $1 million. However, in your CRM, it's only listed as $50,000. Can we double click there? Give it a little bit more of an example. So that helps us bleed into the third factor here, which is trust. We're working with them for 3 months. We have to be able to trust that if you can't deliver on promises in those 3 months, I'm not sure you're going to in the next 7 years. If you can't keep up with reporting for 3 months, reporting and accuracy over the next 7 years is going to be a challenge for you as well. I mean, you can hire for that and augment that, but there's a level of partnership that we have to have with our companies. And so we anchor on that pretty heavily as well over those pilot periods. And so we have account managers that will manage the campaigns. And I always ask them, how was it working with this team? Did you enjoy it? Do they value you? Do you value them? Were there additional insights that they brought you? Was there something that you learned from them that can make us better? And vice versa.
That's awesome. So let's talk about LATAM, US. What US market assumptions trip up Latin American founders most often, and vice versa? You know, as you kind of look at the Latin American market, what kind of trips you up most often?
Yeah, the Latin American market is really interesting right now, and it's changed a lot in the last 3 years. The Latin American market, if you generalize it from a software investing standpoint, it looks very similar to the US market 5-10 years ago. And there are certain instances when you can just follow that trajectory. You can say that legal tech will follow the same scale. FinTech specifically will follow the same scale. Manufacturing or supply chain tech will also follow along a similar path. But there are nuances to it internally as well. And I think what we found and seen is it's very difficult for US companies to enter into the Latin American market. It's also challenging for Latin American companies to enter into the US market. Specifically on the latter, Latin American companies want to enter into the US market as quickly as possible. It's the white whale. There are a lot of attractive things about the US market and specifically the customers that we can bring. However, it's not always the best decision. And so what we'll see is go own a country, go own a vertical and a subset of countries, and then eventually let that pull you into the US market. And so we've actually used this as part of our thesis. I'll use logistics as an example. We're looking at 2 logistics investments right now. One of them wants to move into the US immediately. The other is ramping up all of their customers in Mexico. Their last 2 customers are actually US-based companies, and they've gotten their Mexican subsidiaries. Well, it's a pretty easy decision for me at that point. Your subsidiaries are going to bring you into the parent company versus going into the US market and having to set up everything there, make sure you're compliant in the US. Let your customers pull you in, focus, own that area, and then there's a really good chance that you can grow as a Latin American company into the US. And you know, the last thing that I'll say about US and Latin American companies is, and we see this again for US versus Europe too, but the valuation that you choose is quite significant, quite different. And so there's probably a 20 to 40% discount on valuation for Latin American companies versus US companies doing the exact same thing. There is a good reason for that though. For Latin American companies that are going to remain in Latin America, there are significantly fewer number of exits that are north of the $250 million mark. So there's not as many fund returners. So you have to base valuation at a lower number just so you can reach the multiples that you need to be a fund returner.
Yeah, that's really good insights. Let's talk a little bit about, just touch on AI native go-to-market. You guys seem to be doing a little bit of this. What are you guys kind of seeing in that space that you're excited about, and anything keeping you awake at night in that area?
Well, we're in the day and age where we're democratized creating products. I mean, a non-technical founder can go create and spin up a tool in 2 days. We have non-technical individuals on our team building out our complete database for our portfolio companies that's fully automated. And that wouldn't be possible before without a true software engineer. So more products with lower barriers to entry, and you're starting to see that they're going after very similar problem sets. And it's usually the horizontal problem sets like RevOps, bringing top of funnel, or how do you convert customers? There are hundreds, if not thousands of companies out there now trying to do this. The problem with a lot of those being created today is they are not built for the enterprise. That is where, and I get asked this question quite often, which is, well, isn't AI going to disrupt your value add? To an extent, sure. But a lot of the new tools are enterprise ready, and they're not going to be enterprise ready unless you can actually build a company around it. And we have at BairesDev 100 engineers working on our tools to build them out, to make them enterprise ready, to make them scale. And if you're scared about AI creating new products, you should also be scared about how amazing your engineers are going to be, since they're all going to be 5-10x engineers with the AI tools on an enterprise grade software.
Yeah, I love that. Let's talk a bit about the, corporate venture capital as a service. If every services behemoth clones BDev's model, what do you think happens to venture generally? Is there just more of everything done, or what's the impact there?
So it's a very interesting question. The tough part about corporate venture, which there's a pendulum when it comes to corporate venture. You're either, and you talked about it earlier, which are you more financially focused or strategically focused? The corporate should be leveraging as much as they can to drive value, because that strategic element should bring more financial returns in a perfect world. The challenge is not everybody wants to do it, and specifically VC funds too. It's hard. It's hard to found a startup. It's hard to found a VC fund. It's hard to add value to startups, because if the 80-20 rule is in play, it's really difficult to focus your time on the 20% of companies that are going to return all of your capital versus the 80% that won't.
Well, it's actually the inverse. It's, the 20% of the companies driving 90% of the value don't need your help.
Exactly.
So that's interesting.
So then are you adding value to the bottom half? Why?
Right. That's basically it. You're just blocking and tackling the zeros, basically, in your portfolio.
How are you going to allocate resources toward that? How do you underwrite the value of that? Next to impossible. So this is where I say that it's just really hard. I don't think a lot of people will do it. I think some will try and they'll fall out of favor, because ultimately it's a lot easier to write a $10 million check and be done with it and take a board seat, say yes, say no, than getting your hands dirty. And then for us, we expect lead investors to do, call it one of 10, 15 different things and go about this deep in each. And we go really deep in just one area, which is that go-to-market top of funnel. And so we can allocate and focus resources a little bit more. But if you're going to be a true value add investor, it's going to be really difficult. And I think in the next phase of AI, it's going to be even more challenging, because there's going to be so many options out there to choose from, to stay up to date with. And so you're going to have to allocate more to that. And if you're a traditional VC fund, 2-20 model, your management fees, are they going to cover that? I don't know. We'll see. I think that it's a lot easier to say, let's just try and choose better companies.
Yeah, capital allocation is the term for that. Let's wrap up with some quickish, rapidish fire questions. We talked a little bit about this, but what's the most counterintuitive metric you're tracking during these win different pilots?
The most counterintuitive metric I would say is actually spam rate. The reason is that a lot of companies in today's day and age want to be .ai.io. What those companies don't realize is Google, Microsoft, everybody are still blocking those domains. So if you want to get the highest response rate possible, be a .com.
No idea. A recent portfolio company that upended your view on vertical SaaS.
Tally Legal. This is a legal tech startup out of Mexico. Lean team just signed an incredible deal with Amazon, which is going to 8 to 9x their revenues. And the original thesis was that they were going to be the Zen business of Latin America. What we're finding out is that we have so many US companies wanting to be in Latin America these days that they can just anchor on being the gateway for that and setting up those companies. And then you can see a lot of the network effects after. We're helping them, let's say, Amazon third-party sellers. Let's find them warehouses. Let's find them logistics partners, et cetera. And so we had to change the thesis, because I thought it was all going to be Mexican companies coming through but ends up being US companies.
What's a book or essay you hand founders for advice?
Book or essay that I hand founders? Great question. It's Phil Jackson's 11 Rings. And I'm a big sports fan, but there is something to how unique Phil led the Bulls and Lakers. And we'd always talk about how zen Phil was, but it was how he treated his players that is the most interesting. And I'll give one example, which was, towards the end of the season, Phil used to hand out books to each one of his players, and it would be an individualized book. That's 15 books that he would have had to have read each year to hand out based off a player, and he would have all of them read it. And they would, a lot of the times, resonate really well with the players and maybe open up a door or two. And it was, I would call it vocal leadership, but that soft leadership that it's hard to argue with the results Phil Jackson brought to those teams.
Oh, that's awesome. I'm a huge basketball fan, so I'm going to go read that book. Thanks for that.
Shoe Dog is obviously, I think, the baseline, but 11 Rings.
Okay, 11 Rings. I'll check that out. What's a policy change, either in the US or LATAM, that would unlock a flood of quality startups?
I'll talk about Latin America because there are a couple countries there that have challenging legal guidance around founding startups, leaving companies. Brazil is an example. There's no safe instrument. Not that a safe is the best instrument there is, but there is no safe instrument there. It's very challenging to make an investment because you have to set up an entity in Brazil to get it done. There's a reason not a lot of US capital on the venture side, and sometimes even the private equity side have gone in. And so the workaround is right now it's called the Cayman Sandwich, where Brazilian companies will set up entities into the Cayman Islands because that structure is a lot more familiar to US investors. Brazil could come a long way in terms of being more investor friendly from the outside if they do want US investors. Now, they may not want as many US investors. It's a massive population. We have one investment there, Eco Health, invested alongside Thrive, and they're doing absolutely incredible, but they've already figured out the legal side, which is great, but they're one of only a handful of companies that have.
What's your favorite use of Gen AI in prospecting you've seen so far?
Best use? This is a fantastic question. I think the auto response that you can get in terms of quickly following up. So I'll give an example. If we meet with a company, we now can have completely customized responses and automatically create follow-ups if we haven't received a data room or anything like that. And it's not a massive leap in general intelligence, but it's how quickly it was for us to be able to build that solution. And we use Work Auto on the back end for all of the plumbing. And now being able to automate a lot of that can just reduce the amount of hours we spend on following up or customizing a message and call that 4 hours a week. Well, when you multiply that over however many weeks you want to, you're talking about weeks, months of savings.
What's Work Auto?
Work Auto it's just plumbing on the back end. Think of it like Maker.com, where you're just connecting LLMs to whatever databases or whatever tools you have on your side. It's fantastic.
What's your bold prediction for venture capital or B2B SaaS funding in 2026?
My bold prediction is that I actually think that AI starts to fall a little bit out of favor. Now, when I say AI, I'm not talking about the AI tech stack. LLMs, hence agentic AI is still going to drive a lot of venture capital dollars, probably north of 50% of venture capital dollars. But I think we start to see a resurgence on the vertical side. And I'm sure you receive pitch decks like this where everybody's somehow an AI company. And instead, I think we start to build back towards, no, this is a problem in the market and we're going to solve it. There's one thesis area that I'm really leaning in on. And if any listeners have anything like this, my plug is reach out. But
call for a startup.
Yeah. Is if you are able to unlock, call it untapped resources or value, then I think that there's going to be a wave of those in the next 2-3 years. Here's an example, Pinata Rent, which is leveraging the rent that you're paying, which you weren't getting valued for a long time. And another one, look at Yendo, which built the HELOC for the car. So you have equity in your car. Well, there wasn't a way to access that before. There's another couple companies out of Austin right now that are building this on the mortgage side, where if you don't want to refinance your mortgage, how do you actually access that equity without giving up that interest rate that was on your refinance? Because what if it is 2.9% from the 2022 days? There are examples of companies that are leveraging your network and helping you monetize your network where you weren't able to before. There's going to be, I think, a lot of those companies solving and creating actual problems. And solutions where today it's hard to figure out what that value is. I can't just come up with a solution or else I'd have a startup on the side doing it. But whenever you really double click into what is not being monetized or what is not yet being valued, that's a very interesting thesis standpoint for me.
How do you stress test a founder and their founder market fit in the first meeting, say under 30 minutes?
It depends if you're vertical or horizontal. So if you're vertical, then tell me the story about how this problem exists and exactly how you solved it, or exactly how you witnessed it or experienced it. Very easy to get an answer out of them in 30 seconds. The horizontal side is a little bit more tricky, especially if you're building a DevOps tool. Most likely you're an engineer, but not always. And so for me, when I talk to them about founder market fit, the next thing that I'll ask them is who your competition is. Because I want to know that you have at least seen what other solutions are out there and you are building something that's better or different.
So when you need a mental reset, what do you do?
Work out in sports. So I'll go play pickup basketball for an hour or two, or I'll go work.
Do you guys play like the Lifetime there? Is there a Lifetime Fitness?
Lifetime Fitness. There are, just open gyms as well, church leagues, all those things. Or I'm a part of a basketball league where we play on Wednesday nights too.
Yeah, I played tonight actually in my old man league.
Love that.
Yeah.
It's great because there's no phones.
It's where I get to reconnect with my inner child, I think, and just kind of just be in the flow of running around and passing and shooting the ball. It's amazing.
I will say the other thing that's great is the complete inverse of venture is how quickly you get feedback. In venture, it's 5 years before you get feedback. You can go win a basketball game in 10 minutes, feel good about yourself, or know what you can improve next.
Yeah. It's a make or miss game for sure. Well, this has been a fun conversation. Where can folks find you online, especially startups?
Yeah, LinkedIn is the best right now, and reach out. I'm happy to connect. We've got a team of associates too that you can reach out to, but find us there.
Well, thanks so much, Collin. Really appreciate it.
It was a pleasure, Brian. Thanks so much. Have a good day.